right?
Yes.
Okay.
All right. Good afternoon, everyone. This is our week four workshop on the topic today is capital asset pricing model, CAPM. We'll be discussing on today. So just before I start the class, please share any issues, anything that you guys want to talk to me, any questions, any issues, anything that you want to brought attention, please. And we are recording now, so if any of you don't want their face to be recorded, you guys can keep your video off anyway. That's all right. Yes. Any questions for me, guys? No? All right. So our quiz is starting. I think the quiz, I'm a little bit surprised that this thing doesn't give me much appeal to these things, to be honest. I think I should. Well, like if you go on assessment 1, practice quiz 1, I understand these were practicing for the students that they can practice before they attempt the actual quiz. I understand that. That's very sensible. Practice quiz 2, the same. This one doesn't actually make sense to me. Online homework. Students might take it as a homework. And homework, they don't care much, do they? So this is one technical thing I think I would say. But yeah, but this is the quiz, isn't it? Online homework 1. This is the quiz, isn't it?
Yeah.
Yeah. Yes, online homework 3, 4. So yeah, so when it says homework, it's not much more appealing for, or doesn't give that emphasis and significant that this is a quiz. Student must need to sit for this one. Yeah.
Excuse me, sir, I have a question.
Please go ahead.
I received on my student email that the assessment 2, the individual assignment will be open on Monday the 26th and will be closing on week 10. And that this assessment, we should submit it to Dreza, not you?
Everything goes to Reza.
Okay. No, okay, got it. Thanks.
Regarding assessment, it all goes to Reza actually. Otherwise, he will send you an email address that this is the email you will have to submit, so you know which way it goes.
Got it. Thanks.
If my email address is there, fine. If it's not there, send it to him only. Yeah.
Okay.
All right. So, yeah. Let's start our party here. Capital asset pricing model. This is very interesting one, and a lot of people actually use. Okay, well, this is the thing we used to do it just for one variable. And before I talk about this one, I would like to give some introductory talk about this one, what it is, how it is, where it's coming from. These things we'll be talking here. Okay, so let's talk about it. Okay, if I ask you today that I know, let me name some of my students: Edward, Haura, Hugo, Ishita, Giorgi, Jackie, okay, John Trobas. All of you have, let's say, $100,000 in your bank account. Okay, 100,000 is too much. $50,000 you guys have in your bank account. Okay, and you guys are getting, it's a savings account. So without any failure, any issues, you guys are actually getting some return, isn't it? You guys are getting some return without any failure. But if I tell you now, I want you guys to give me that money, would you do that? And I will be actually giving you some in return. Will you be happy to invest with me? Yes, I'm expecting some discussions here, friendly discussion, please. What do you think you're gonna do with me? If I give you this offer, that I want this $50,000 from each of you to give it to me, would you be interested to give me the money? You are already getting, let's say, 2% your interest getting from the bank. Will you give me the money?
Depends what we're getting in return.
Yes, you are actually interested to get, you are getting 2%, right? Just be honest with me. Tell me, won't you ask this question? I'm getting 2%. Muhammad, what are you talking about? Am I going to get more than that? If I say no, would you be interested? You will say straight, why should I give you money then? Give me one good reason. Why should I give my money to you if I am not getting 2% that I'm getting currently from the bank? Isn't it? It's very normal sense. So you'll ask this question to me, definitely. Now, if I tell you that, well, I will definitely give you that 2%, which you are getting risk-free, you are getting this money without any problem, without any hassle, without anything, you're getting it. I see that. I'll give you that 2%. On top of it, I might not. I don't know. I'm not sure. What do you think? Are you happy?
Maybe.
Maybe, yeah. You think, well, I'm guaranteed getting 2%. If he gives me nothing, that's okay. I'm still getting what I'm getting right now. But if he can give me something, even better, isn't it?
Yep.
That's the normal common sense of making investment. We'll be talking about this part today. Okay. So what defines how much you will get, what you will get, why you are interested to take the risk, why you are not, these things we'll be discussing. Okay. So this is in general the expected return of an asset. Asset, that's what I mean, the share. Like share, security, bond, these things we call asset. Should be positively associated with the risk. Positively associated means positive relationship, which means the higher the risk is, higher the return should be, positive relationship. Okay, so yeah, they mentioned already, higher the risk implies higher the return. CAPM links systematic risk and expected return. In other words, CAPM is a model that describes the relationship between risk and expected return of a security. It will tell you how much risk you are taking. Who started it? 1952, Harry Marquis. Then it's been developed by many people. Then Sharpnell did it in 1967. He improved it better. Okay. Broadly, CAPM relates to the required return on a security to the risk-free rate of interest. Look, CAPM relates the required return of a security. It's been shared then. When they say security here, like look, we say Australian Stock Exchange. Why they call it share exchange? Did you think about it? Why they don't call share exchange? Why they call it stock exchange?
Because this is where you exchange. I mean, this is where the giving and return happens.
Stock is a bundle of shares called as a stock.
Yeah.
If you buy one share, that's one share. Like 10 shares together is one bundle of share. That will be called one stock. That's how they treat it. And security. Share market is also called security. Like Australian Securities and Investment Commission, ASIC. This security means share market. All right. So they may require return of security to risk-free rate of interest. That's what I'm talking about. The 2% I'll give you. Risk-free rate of interest, I'll give you the 2% plus the volatility. I'm not sure. Variability, it will vary how much I can give you. Of the securities return relative to the volatility of the returns of the market portfolio. It depends on the market. That's why I can guarantee you. This is the problem. And this, to the volatility, the number two, the volatility is measured by the security beta coefficient. We have to measure the volatility, the riskiness. Okay, which is estimated as a slope coefficient of a regression of the securities return. So you understand the point now, right? We are going to actually see where is the riskiness. Okay, return on security on the y-axis and x-axis market return. Okay, so you are trying to develop a relationship between market return and the return on security. What is the relationship? This relationship is here in the middle one. This line tells you market return and return on security is positively correlated, positive relationship they have. Simple regression lines, we have a positive relationship, we can see that. Okay. The slope of the simple regression line is an estimate of the security's beta coefficient. The slope of the slope, this slope of this one, you guys know how to calculate the slope, do you? Do we all know how to calculate the slope? Or do you know what is slope in a line? The slope is this angle is the slope. Okay, this angle. And how do we actually show that? I'll show you how do we show that. You guys have seen these things many times. You can see what we share here. You guys have seen these things many times, like this. See, that's how you calculate the slope. What does it mean? Length by base. You calculate the slope. Okay. You guys done these things in your high school trigonometry. Okay. That's the slope. Like if you remember that line, the equation of a straight line, y equal to mx plus c. M is the slope. Or y equal to a plus bx. B is the slope. Okay. So now in this chapter, we'll be discussing only the systematic risk. Okay. The market portfolio will have this. Okay, let me actually show you the CAPM. This is the one, CAPM. Formula is this one. This is our CAPM formula. Am I right here? This is our CAPM formula. Capital asset pricing model formula. So what these things are actually, what these things? We need to know these things. RJ, okay, let me write it down. Let me write it down. It's actually written in here, but I would like to do it by myself, so like step by step, you guys can understand better. That will be nice. Look, insert equation. Width is too small. Is it big enough?
Yeah.
Good. RJ. So RJ is actually meaning a return of a portfolio. Portfolio, or let's say return of a share. Okay, return of a share will be.
Wait, RJ is return on the portfolio?
Let's say share, not the portfolio. Let's say we're return on a share.
Okay.
You're investing West Farmer company, what will be the return of the share in this company? Okay, you invest 50, you're going to invest, let's say $100 you're going to invest. What you are expecting back? This will be equal to, you will only give me the money if I can give you an assurance that you will get, definitely you will get a risk-free return, the 2% I was talking about beginning of the class, the Commonwealth Bank or any other NAB or that.
So we have that.
That return. That is known as risk-free return. Okay, RF. F. You understand, it's free. That's why F is coming here, free.
Yeah.
This is you will get. So the return you will get is this one, plus you will get something more. What more you will get? You will get this one. Now these are smaller. Rn. Rn minus, what is Rm? That's what I need to explain.
The return on
Rm is average market return. Okay, let's say investing in pharmaceutical companies. Pharmaceutical companies are very hot now because of COVID vaccine. You're investing in a pharmaceutical company, for example. Okay, and you see that, okay, well, pharmaceutical company is going to actually now recently pharmaceutical market is getting let's say giving you 10% return. 10% is too high. Let's say 5% return pharmaceutical company is giving now. If you invest in pharmaceutical company, you can get 5% return. Okay, this is that 5% market return. Okay, minus RF. So what does it mean then? RM minus RF. What is this? This portion is called as market premium. This portion is known as market premium. If you invest in the market, you get these things. Okay, that's market premium. Since you're investing into the market, you have gone out of the savings now. You have gone out of the savings now. So market is giving you 5%, right? Market is giving you 5%, but you're already getting 2%. Remember from the bank? You're already getting 2%. So what is the benefit you're getting coming to the market? 3% extra. Make sense, guys? That's why I said market is giving you 5%, but savings account was giving you 2%. The gap between these two is 3%. This 3% you are getting because you're coming into the market. You're calling it market premium. Make sense? Is it clear to you all? What does this portion mean?
Yep.
Okay, cool. Now, another interesting part now I'm going to bring this, which is called as beta. I'm going to bring the beta. Now I was waiting to bring the beta later. There is a history behind the beta. Beta G. What is this beta? We understand. Now let's go this way. Let's put it this way. Here, this is 2%. You getting? No. This is the thing we have to find out, right? So this is the thing we have to find out. So this is the thing we have to find out what will be the return of this share. So this is 2%, we understand. This is 2% you are getting from the bank. This is 5% you're getting because you're coming to the market. On this industry, pharmaceutical companies giving you that. Make sense? This 3% you'll get. Okay. Now,
Yeah.
what is this beta mean? This beta is the riskiness. This beta is the volatility. Who gave you this guarantee of 3%? Nobody. There is no guarantee of this 3%. But you see, market is on an average, market is giving 5% now. Which market? COVID vaccine is giving you 5% now. Also, Netflix is very good now. Streaming industry, or let's say online credit card, buy now, pay later, BNPM, that companies. They're doing very well because of the COVID. So this company give 5%, but is that a guarantee you will get this 5%? No. So what is this 5% market return? Average return of the market. Netflix is giving, let's say, 7%, COVID vaccine giving 9%, let's say Zip, that Zip company or Klarna, Zip, Afterpay, those companies giving, let's say, 6%. So he's saying on an average, 5% market. That's what he said. That's what it is 5%. Now, Do you think it's a guarantee? No. It's not a guarantee. So these 3% extra market premium you will get depending on B. What about B becomes 0? Scared? What about B becomes 0? What about B becomes more than 1? What about B becomes less than 1? What about B becomes just exactly 1? So this B is the riskiness. B will define what you will get. All right. So let me write it down here. This is 3%. And these things I will take out so you guys can understand it better. See? So 3% is market premium. How do you calculate that? RM minus RF. Actually, I should not do that. This was not very fair on these things. Maybe I should copy this one and 3%. Now you can understand it better. Okay, so this is the concept is known as capital asset pricing model. That's the concept. All right, let's move on. Now you understand this, right? RJ is required or expected return on an asset. RF, risk-free return. Express return on market portfolio, RM. That's the market what we're talking about. Okay. And beta is the beta of the asset. Riskiness of the business, which company you are making the investment. Riskiness of the. Don't think this beta is the risk of the market. No. C is J is J. It means the same company, same thing we are meaning. Okay, that's same thing we are meaning here. RM minus RF, market risk premium. Got it? This is the concept of capital asset pricing. All right, so hope you guys are happy with this one. Security market line, SML. This is a graphical representation of CAPM model. The graphical CAPM model. The expected return on the stock with beta 0 is equals to risk-free return. So now they mean here, I told you already, I told you here exactly that if beta, what about happens if beta equal to 0? This is 0. How much you getting? 2%, remember? Savings account. That's the risk-free return. I think I should write it down here. That would be nicer for you guys to understand. It's actually mentioned in there. I don't need to, but still I will do so. Out of the risk-free return. Then beta is the riskiness of the asset. Asset or share. I will say the bracket share so you guys understand. RF, beta, riskiness. Okay. I have to write down that RM. RM is equal to market premium. Market premium. Okay. And you guys know the other stuff. So. DJ, the RJ is not mentioned. Let me write down RJ too. So don't get confused. RJ is equal to expected return. Expected return of an asset. You want to invest, let's say you want to invest in Zip or Afterpay or Koala Mattress. So these things are should not be a problem now. Nice. So what happens if beta equal to 0? The whole part becomes 0. you get 2%. What is this 2%? The risk-free return. Okay. That's risk-free return is 2%. So that's what you're trying to say here. Beta equal to 0, then you get your risk-free return, your RJ equal to RF. Sorry, RJ equal to RF. Okay. So here, so risk-free return starts from here. Why is it starting from here? Riskiness starts from here. Why? Because even your risk is 0. Look, this line is beta. X-axis here is beta risk. And y-axis is required return. So if your risk is even 0, is your return 0? No. Your return will be at least your risk-free return, which is 2%. In our example that I started the example in the class first. Okay. So that's what it starts from here. And this one shows you the higher the risk is, market risk premium higher, the return is higher. All right. So higher the this one, the systematic risk or the beta. The higher the beta will be, risky will be, higher the return will be. The market risk premium. Market risk premium is this gap, you see. This much you are getting all the time. You're getting always this much, you're always getting. The extra one you're getting because you came into the market. That's the market premium. All right. Okay, next. So yeah, they try to make all the things. Now, two of them we're talking about, 2 shares, for example. Okay, so different might have different shares. Now I think we're going to move into portfolios. Now, for the assumptions of the CAPM include, what the assumptions we have in CAPM, this is very important for you to understand the assumptions. Okay, this says the existence of perfectly competitive capital market in the decision to buy or sell of any individual will not affect prices. When we made this capital asset pricing model, we are assuming that the existence of perfectly competitive capital market. We assume that capital market is perfectly competitive and perfectly exists perfectly. Is it so in real life? No, it's not. No impediments to transactions, no transaction costs, no taxes. That's what they think. Is it true? If you make profit on share market, you make money from the stock market, you have to pay taxes. It's not true. There are some assumptions out there. All investors have the same information and hold the same expectations about the probability distribution of the returns of the assets. Is it true? No. Not all investors will have the same information. Different investors will have different information. And their risk-taking habit, okay? Their habit of taking risk is also different. Okay. Now the difficulties in theory, the inputs used in SML, okay, equation should be known ex ante. What will be the rate of return on the market and the assets. But our estimate of these inputs are based on historical exposed data. The security market line equation, that equation we're talking in here, these equations we're talking in here, this says that in theory, the inputs used in the SML security market line equation should be known ex ante. What will be rate of return on the market of the assets better. But we are actually using the historical data. That's what we do. We use the historical data actually all the time. When we make a prediction about a share market, a share or a market or a riskiness, we're using the previous data, historical data. Okay, so anyway, the whole point is this CAPM has some issues, problems. Okay, since it has some problem, it has some errors, what are you gonna do? We're gonna add an error tag. We're going to add an arrow term. This is ET. This is our arrow term. Okay? This is our arrow term. And we're going to add T. Why we are doing this T? Because it will vary from time to time. Okay? All right. So what we're doing now, we are actually going to add a T at the end. Plus ET. Is arrow terms we added. Now calculation of beta, we will not expect that you know how to calculate the beta, but we expect that you know that formula how to get it. But I believe the formula will be provided as well. Anyway. Okay, so here is our calculation of beta. We're calculating the beta from here. Okay. So this one I have already showed you guys. So what they did is like they moved this one to the other side. Okay. And they came up with this beta into this. Now you notice here that what we did, we actually multiplied with this figure on both the sides in all the forms. Okay. And we also multiply it again with 1 by n a. That's what we have. Okay. So don't get upset or don't get think that, oh my, it's so complicated, these things. Don't worry about these things. You don't have to derive this equation. We already derived it. So estimated beta figure is the formula for estimated beta is this. That's what we want to tell you, let you know. How did we get this formula? That's what we showed in here. It's okay. Estimated beta will be 1 by n into summation of rjt minus rft into rmt minus rft divided by 1 by n. So look, this and this can be cancelled out easily. Okay. Anyway, so now final formula is this one. Rho jt, rho jm multiplied by sigma j divided by sigma n. That's the formula, estimated beta formula. Okay. So what this rho means? Rho is the estimated correlation coefficient between Rj minus Rf and Rm minus Rf. This is the estimated correlation. The correlation between these two. And sigma is estimated standard deviation of this. Sigma n is the standard deviation of this. So these and these two. Okay. So let me show a little bit and try to give you a little hope that you don't get upset. Okay, so this is the case. Just change the side. Just change the side. Okay. So now we are saying that what is this rho? Okay. Rho is the correlation between, you see, this one between this and See, that's it, nothing else. And sigma, oh, I need to say this. Look here, RF is on the both sides, see? Just the J and A. Okay. And this one, I'll write it later so you guys can understand why I'm writing that part. Is for, let's take the first one. Standard deviation of equal to standard deviation of okay. Now go to the next one. Standard deviation of that's it. See, so it's all from this one only. The standard deviation of, look, F is everywhere the same. We do not use F. Risk-free, you know, is very simple. Risk-free, keep it simple. Sigma here, this will be 0. And this one will be 10. That's it. Okay, this is your formula for that. And you say here that beta is equal to so here beta J. No, I should not say B. J should be equal to rho, this one, Jm multiplied by 9. So divided by that's it. So these beta also calculated using these things. Okay, that's it. That's done. All right. So now, what is this risk-free return? How do we know this risk-free return? That's what they're trying to say here. Where this risk-free return coming from? This risk-free return is coming from government. When you buy a government bond, you are guaranteed you will get the money back. Okay? You'll get a guarantee that you will get the money back from the government. That's what government does. They give you assurance. And normally, how do they do these things? Normally, this is in USA. This is called US Treasury bonds. They use US Treasury bond. Then in Australia, we have T-bond as well. We have bond markets. So that's the bond. Government bond will be our way of discussion. Government bond is the guarantee. Then the commonly accepted proxy for the risk-free asset is government-backed securities. Government government-backed securities carry some risk of default, but the risk is very low. Okay, government always pay our money back. Okay, United States, United Kingdom, Australia, New Zealand use such securities as proxy for the risk-free rates of return. That's what they're saying. Yeah, in the United States, current treasury bond bill or T-bill, they call it T-bill. T-bill has couple of differences. Like some of they say like 90 days bill, 60 days bill. 90 days normally minimum they go. A 180 days, 6 months bill, 1 year bill. So it depends on what is the rate. Okay, so different T-bills will have different rates. Okay. So what next? The T-bills are considered nearly free of default. This is because they are fully backed by the US government. So far, the government of the United States has never defaulted on a debt obligation. Never during the time of the, even not during the time of global financial crisis. So they are very secure. That's why we call it zero risk. Anyway, let's move on. This is an example we are working on now. Any question for me, guys? Any question for me? Any of you? No? That's good. All right, so we have some data in here. Consider the following data. Required return of J, market return, risk-free return has been provided in here. Yes, anybody want to say something? No? Calculate the beta for asset J. Calculate the beta for asset J. Okay. So these things are provided in here. So this is the required return for the asset or expected return. This market return is here and RF is in here. Okay. All right. So what we are doing here, we are actually trying to figure things out. Okay. How we are doing this? I think it's very easy if you guys look at here, because it's nothing serious. Look, RJ minus RF. So RJ minus RF, that's the figure they got here. If you want, I can do it too. It's not a big deal, but take it to Excel. So required return, market risk return, you get it. So here we're gonna do RJ minus R equal to what? This minus it's free. It's not very properly written. All right, better. Oh, gosh. Oh, no. What's wrong with this? User need to go. Because Excel doesn't handle the equation very well. Required is here RJ, market return is RM, and this one here is RM. Now you can understand it better. Okay, so if this is the case, then drop it down. Done. And RM minus RF. RM minus RF will be equal to RM. Right? Average. Go to average. Not the sum I'm looking for. average 1.31. Average for next column 0.89. 16. Well, since someone sent me direct message, so I'm not going to discuss in front of any other student. I understand. Of course, the person who sent me, that person understand, and I will talk after the class with you. Okay. All right. So this is here is average. That's how they calculate it. What else we need? Average, standard deviation, variance, coefficient of variance, correlation coefficient. So all these figures need to be calculated. Then you calculate the beta figure. We need correlation coefficient. We need standard deviation. These two we need mainly. For the correlations, we need this variance and these things too. That's how we calculate these things. Okay. You can calculate these things manually using this formula. What is the formula? This formula. Okay. You can use it by using this formula. I normally use Excel for these things. Standard deviation. Earlier. Okay, you know what? I'll show you guys a very nice trick now. Have a look what we do. This thing is very interesting as well. Like if you go to options, and there is a nice thing at the bottom, add-ins. If you go to add-in, where is the add-in? Add-in, and you can Excel add-in. Go. I want to add data analysis toolpath. Analysis toolpath. Okay. All right. Okay. Now I will have another tab in here for data analysis. Analyze data. Click in there. Yes. For this one, normally could not find any pattern. Yes, I know. I didn't select any data yet. So if I select this one, analyze, and I click analyze data. What I want, God asked me what I want to do. Okay. Standard deviation. What is the data analysis? Normally it comes in here. Let me try again. Normally you get it into A data analysis. Here we go. Yes, now in data analysis, we will find standard deviation. If you give descriptive statistics, it will also give me the same figure. Okay. I can straight get the correlation figure, to be honest. Descriptive statistics will give me the same figure as well. Input range. Okay. Output range. Let's say I want it on H. No, what is this one? Name on F. Here. I want the figure in here, for example. Here I want. Okay, summary statistics. That's all I need. Okay. Look what I got. Very interesting, you see. Mean, standard error, standard deviation, you see. 2.003034. Check in here. See? Standard deviation. For second one, we get the same figure. If I do exactly the same thing for, let's say, I will delete this one. Let's say we got this column 1. Let's say here you got for the other one, RF, this one. Okay. Now, it's in data, right? Data analysis. Let's get to statistics again. So I want to get not that figure, I want to get not this one. Okay. And not 3, I3, this one is J3. All right, I'll just delete it. I want it in J3. Summary statistics. Yeah. See, estimate deviation will be for the another one, 1.089. I don't need other things, to be honest. If I need just this one, yeah. I don't need other things, do I? No, not at this stage. And what else I need? Variance, coefficient of variance. Oh, variance already there, I believe. Where is the variance? Sample variance is there. See? 4.012143. See? 4.012. Yeah, 1.18. Variance is also available there. Variance is also available there. Can I copy these two separately and bring it in one place? Let me see. Yeah, it does work. Nice. And what else? Some maximum, minimum range. Yeah, that's it for now. Okay. Let's delete them. I don't need them now. Cell format. No. So I got my figure. What else I need? Coefficient of variation, correlation, easy peasy. I'll show you. All right, so this one. Let's go to data analysis. Coefficient of variation. How is coefficient? I think it should be coming from covariance. Let me check again. Coefficient of variation, covariance, and coefficient or correlation. Okay, correlation. All right. So this one, let's say for covariance. Input range. Columns. Output range. We want to do. 0.0524. 147. So this is, I think this figure is not in there, but let's get to the correlation coefficient straight. Let's see what we get from there. I think data analysis, they don't have that coefficient of. Have it now. Have it. Let's see what other options they have. No, not that. All right, I'll go straight to the correlation. Okay. Input range. Grouped by columns, yes. Zero 0.96604. Okay. 0.96604. That's what is my coefficient of column 1 and column 2. So these and this. Got it. Okay. Coefficient of variation in Excel. I really don't want to spend my time on these one, to be honest, to look for what they are. Let me see how much we have to go. Look, we don't have to go much, actually. I can try. Oh, nothing much is left, so I can try actually. Variation in Excel data analysis. Yeah, coefficient of variation in Excel. How did they calculate it? .25, 1 minute video.
Grammarly can help you write quickly and confidently, so you never have to slow down at work. Stay on top of emails, documents, and
Today we are going to see how to calculate coefficient of variation in Excel. Coefficient of variation is a measure of relative variability, and it is a ratio of standard deviation to the mean. So here we have protein concentration from the assay. 3 different readings are coefficient of variation. The assay is. So to calculate coefficient of variation, we need a mean or the average and the standard deviation. To calculate mean in Excel, we can use the.
Okay, no, they don't have. We have to calculate it manually anyway. Leave it. It's not in there, so we have to go in manually, not like the way I was doing. They don't have any formula like that now. Anyway, we got the other parts. Yeah. So correlation is this one. Okay. What about our beta value? What about, so actually we don't need the value. Okay, let's take this one. So now beta will be what? Okay. Beta will be equal to, what is the formula? Formula is
Standard deviation minus
correlation multiplied by J. Remember this one? Rj minus Rf. This is the deviation of this one, bracket close, divided by 3.266 days. How much we got it here? Oh, okay, wait. Our correlation coefficient is also not right. It's 8. Which problem you're looking at? No, no, I'm looking at different problem. But okay, wait. I'm pen down. Okay, yeah. 1.7763. Let me check. Mhm. Correlation is fine. 966. Okay. Standard deviation is 2.00. This. Let me get my calculator. Give me a second. Yep. Zero. Okay, looks okay. Yeah, right now standard deviation is 1.0893. Let me see. What did I make them? 0.0893. So what did we make the mistake? Oh, look at that. 17, 16, 16. I used variance, not the standard deviation. The standard deviation is actually on 15. I made the mistake. Sorry, my bad. This one. I used actually variance in there. Yeah, it should be actually, this one should be equal to correlate, first bracket, correlation. Okay. Actually, I don't need a bracket anyway. Multiplied by standard deviation. This one, I use this one, not right. Okay, bracket closed, divided by this one. 1.7. Okay, we don't need variance actually, to be honest here. If we can get the correlation, we don't need a variance. So that's the better way. But you can do it easily using Excel, but if you want to do it manually, to calculate the correlation, you need the covariance. That's what the problem. All right, so it's done here. Let's go to the next point. Okay, row is given. Oh, it's all given. See that? All is given. Oh, this is the one we just done. Oh, this one we just done. Actually, they are not talking. So now the question is, we got the beta value as 1.7763. What does this mean? 1.7768, 1.768. What does it mean? This is the answer we had here. Okay. If beta value is less than 0, look, if beta value is less than 0, return from asset J generally moves in the opposite and compared to the market return. Beta equal to 0, return from J is uncorrelated with the market return. If beta is greater than 0 but less than 1, so it means decimals, and anyway, these ones, less than 1, return from J generally has the same direction with the market return. Beta equal to 1. So these things you will have to know how to interpret them. Another thing I would like to add here, okay? Another thing is if beta value is goes more than 1, it means the stock is very aggressive. Stock, okay? Aggressive share, very risky and aggressive. Calculating the beta using stock market data collection from Yahoo Finance, monthly data for XYZ Corporation, February this to this, example only. Okay. Beta value from this is an example that we can actually do the same thing exactly by getting the data from all ordinary XYZ company market risk-free rate. Okay. FM, this is an example they have given. And I think I have showed you guys already on one class that how the Apple share market was fluctuating. I showed you that. That time I showed you that how to get historical data from Yahoo Finance. So we are so this much is given, exactly doing the same thing. Just calculate this too. I think your assignment is also the same thing, I believe. Okay, now let's solve some of our problem set. Okay, exercise to be done in the workshop. Okay, under what condition will the population standard deviation of the return to a two asset portfolio to be weighted average of the two asset standard deviation returns? Means consider the formula for the standard deviation of the return of two assets portfolio given in the lectures and recall from high school that a plus b is equal to this. Okay, so this is our formula set. Let's solve this problem. Okay. So how do we calculate these figures? We'll say here rho P is equal to root of, let's say, W1 square W1 square. Next is okay. These are from. So we do the same thing. This plus for second one, okay, plus, okay, 2 into W1. Okay, here it should be not 1, it should be 2. It should be here. W1 row 1, W2 row 2. W1 row 1, row 2. Okay. So W1, W2, row 1. Okay, so this is the case we have. So now what did this says here? Under what condition will the population standard deviation of return of two asset portfolio will be weighted average? So two assets, so two asset one and two, so one and two assets we mean. Weighted average. So we bring the weight with W, two assets, standard deviation, as standard deviations of returns. So this will be the case. So actually I should take this only go actually till the end. So oh, God, no. That's what it should be. The root should go till the end. Okay, that's what it is. So now if this one whole thing will become, look, the whole thing will become whole square, right? So the whole thing will become whole square, then square and root will be gone off. The rest will be left this much. Do you understand what I'm saying? What I'm saying this, okay, let me do it. No. So whole thing will be in bracket, and the whole bracket should have a square. Now does it make sense? This square and root will be gone off, and what will be left is this. That's the whole. Okay. So that will be your answer. Why it's like all right, number two, the possible rates of return you might expect by investing in shares C and D as follows, assuming there are only three types of economic conditions: poor, average, and good. Probability of state of economic conditions. Probability is given here. Return on C, return on D is provided. So now, next one. So calculate the expected return of standard deviation for both C and D. Okay. For both C and D. Express your answer in percentage rounded to 2 decimal places if required. All right. Let's do it here. So EC is equal to what will be Why the machine becomes slow now all of a sudden? Will be equal to what? It's very simple. 2 into minus 5, 0.5 into 8, 0.3 into 14. Okay, then you add them all up, you get the answer. Okay, will be equal to 0.2. Give me a second, let me get out of this one. Then it's not a very good idea to work on the equation straight from the file. Yeah. Okay, there we go. So here we say that expected return on C is equal to 0.2 multiplied by minus 0.05. Okay, plus 0.5 multiplied by 0.08 plus 0.3 multiplied by 0.14. Okay, the answer should be equal to 7.2%. Okay, for D, okay, for D 0.2 is fine. Minus 3, minus 5, 10%. The answer is actually 4.9. That's it. Okay. Now, standard deviations we have to calculate here. So we have to do it. We can do it by using Excel the way I showed you, or you can do it like manually that we can do it too. I would like to take this in because it's hard to work in here because it's old file. Anyway, I'll finish it off. I'll go to the next one there. See, because it's one, if I keep going like this, one of them takes around like 10-15 minutes. I can't, so like it's 7 o'clock and I will have to finish how many? 2 of them. 3, 4, 5, okay, 2 of them. So let's see if I can finish within 10 minutes. All right, it's equal to this one will be equal to, look, how are you gonna do? Return minus average 7.2, all of them. Okay, so it will be minus 5%. So minus 5 minus 7.2. Okay, it will be whole square. Square. Then it will be multiplied by 0.2. First one, okay. So the second one will be plus, we go exactly the same way. Plus, so -5 will become now 8%. 8%, and 0.2 will become 0.2 become now 50%, 5%, and here 40%. Percent 7.2. Definitely. Okay, so this is the case here. The answer should be actually here after doing all the calculation. The answer should be equal to 6.63%. Okay. For D, now it will not be -5, it will be actually -3. And this is not 7.2, this is 4.9%. 4.9% into 2.2 is okay. This is not 8, this is actually 5%. And 7.2 is actually 4.9. Yeah, 14 is not the case, it will be 10. 7.2 will become here 4.9. And the answer should be in this case 4.5%. That's it. That's how you will do it. Okay. 2.50. This is the way you calculate it. Next one is now we have to calculate this. Calculate the standard deviation of return of portfolio with assets weight of 70-30%. Now 70 and 30% for assets C and D respectively. Again, express your answer in percentage rounded to 2 decimal places if required by starting working on the return portfolio in each economic conditions. Okay, all right. So we have to find out our 70-60%. Okay, 70 and 30% only. Okay. If this, in this situation 70 and 30%, we will go with 70% -5. This will be 70%. And so it will be 70%, it goes in there. -5, okay, -5 into 70, -3 into 30. That's how we go. Okay. We'll see what is our portfolio return comes out. So we go here, portfolio return. Portfolio return in each economic condition. Okay. So in our poor, we will say -5 into 0.7. 0.7 multiplied by -5. 5. Okay, plus 0.3 multiplied by minus 3%, right? That's equal to minus 4%. Now, next one is about average. We'll go this way and take it up. Okay, 70 will be remain the same, so it will be our, in this case, 8 and 5. 8, 5. The answer should be 7.1. And good. So, so 0.7 into 2 will be 14 and 10. 14. So now we're doing a portfolio returns. Okay. Now, so expected portfolio, we work on the same expected portfolio we'll be working on now. So we say here, expected returns on portfolio EP is equal to, we'll copy this one, when you do the portfolio, you're actually combining all the shares together, becoming one. Treat as one portfolio, okay? So it will be now 0.2 into 1 share, then the outcome is this. Minus 40. Let's just think it's another one, another share. Let's take it this way. So let's say this one is portfolio. Expected return of portfolio, you get it how much? Minus 4.47.1 minus 4.4. Then here 7.1 and here 12.1, right? 12.8. That's it. Okay. That's the whole case. So now they're asking you to calculate the expected return for portfolio P. Let's say this is P. Asking you do it for P. Exactly the same thing we're going to do like we did for C and D. We're going to do exactly the same thing we're going to do for P now. Okay. That's why I'm going to actually copy these two lines. It will be easier for me to work on and quicker as well. It's not D, it's actually P. Okay. It's not 0.3 minus 4.4. So we'll say 4.4, it will be 0.044. Okay. Then it will be here. What was it? 7.1. 0.071. I'm using decimal, okay? You guys can do some others. You can do straight percentage too. It's same thing, nothing wrong. And it's 12.8, 0.0128. The answer should be 6.51. Okay. And for the sigma, exactly gonna do the same thing. Okay, so it's not 5% anymore. It will be actually here minus 4.4. And here this is not 7.1, it will be 6.51. And these things remain the same. It's not 8. This actually 7.1. 7.1. 6.5. 6.1. 12.8 and 6.5. The answer should be 5.9 now. It's done. Okay. Number 3, the following table shows the returns in percentage on ordinary shares A and B in 3 possible states of nature together. Together, the probability of these states of nature occurring. Okay. So rational, recession, normal, and boom. 3 economic conditions they have. Probability return or percentage B. Calculate the expected return and standard deviation of return A of shares and share B separately. We have just done it. For C and D, exactly the same. Poor, average, good. This says here. Recession, normal, boom. Probability is given, return is given. Do I need to do number A? I don't think so. But well, I will do it. But it will be taking time anyway. I have no problem doing it, but I'm just not sure if it's 7:10 already. All right, let's go ahead and let's see if I can finish off in 10 minutes. Same thing, share A and B. Two 28244 0.2 4.4. The next one is 468. Four, 6, 8, 12.52. 12, 5. Okay. And this one will be 6.4. And this is 5.2. And for the rows, it's not C anymore. All right, so it's not -5 at distance in here. 6.4. Zero point 2. 4. 4. Okay, and the return is here 4, 6, 8. 4, 6, 8. Okay, 1.5%. Okay. So B. It's not 6, is 5.2. 2. 2. And these things are not, these things are 12. 12, 5, 2. And the answer is 3.66. Oh my God, 4 minutes down. Okay, number B. If a risk-averse investor had to choose between holding A shares and holding B shares, which would he or she choose? Give the reasons for your answer. Which one they should do? Look, standard deviation tells you the riskiness. Okay. So which one has less risk? A has less risk. They should hold A. Okay. So a risk-averse investor would prefer A shares as the offer highest expected return and B share lower variable. Okay, so they should hold for A, higher return and not much risk. Okay, next one. If an investor were to inform a portfolio consisting of A and B shares, would it be possible for the portfolio to offer a lower standard deviation returns than both A and B shares and an expected return that is not lower than the expected returns of both shares? Okay. Look, it's not possible actually. Okay. It's not possible to create another new portfolio consisting of two assets that satisfy the both requirements. Okay. So from the table, you can see here. Okay. From the table, you can see here that they're negatively correlated. How? One is increasing while the other is decreasing. They're negatively correlated. Okay. If you combine them both, it will be a cross connection like this. One is growing, one is decreasing. So negative relationship there. All right. I'll go to the next one. If the return on asset A for 2010 to 14 are as follows, 10 to 14 are as follows. Calculate the mean and standard deviation for asset. Oh my God. I'm going to do this one again. This is so easy one. I believe you guys can do this one. Calculate the mean, calculate the average, that's it. Okay, let's do it. Okay. 3 point this one, right? How do you calculate the standard deviation? So you take this one. So average will be equal to this plus this, okay, plus this plus this. So this is plus this plus divided by 3, 4, 5, 6. Two equal to, what would be the answer here? You just got it right. 3.72. Okay. And standard deviation is equal to, copy this one again. See that? 6 times. Okay. All right, so it's not with 12 anymore. It's not 5.2, it's 3.72. 3.72. All right. And there is nothing like these things. We don't need this thing anymore. Plus, 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 plus. Right? So 1, 2, 3, 4, 5. So it's gonna be not 12, it's gonna be 0.52. 5.21. 6.23. 1.20. 3.22. Then 5.96. Okay. So you get the standard deviation, which is 2.4649. Okay. 5. Calculate the portfolio standard deviation of stock A and B from the following given data. Oh my God, again, the same thing. Again, oh, portfolio 1. All right, so it's a portfolio 1 you have to calculate. How do you calculate the portfolio 1? So this one will be this multiplied by 0.65, 0.65 plus this multiplied by 3.5. That's how you get the portfolio 1, okay? 22, I have 8 minutes. I'll try, I'll give it a go. All right, so let me copy this one. Should be equal to this multiplied by 0.65. Okay, close the bracket, plus this multiplied by 0.25. Okay, that's what it is. Okay. That's a portfolio. Okay. Now, when you get the portfolio 1 in here, now we have to do the rest of the part. Okay. So now we have to calculate the mean average variations here. Mean, standard deviation, variance, and correlations. Mean, means standard deviation, variance. Sure. Okay, so let's do it. That analysis, I need the descriptive statistics for this one. Okay. To Z, this to this. All right. That's all good. Output range should be done. Mean I need. Standard deviation I need. Variance I need. Okay. Done. All right. And standard deviation here. Variances. Okay. So that's the way you do. I think I don't have much time. 5 more minutes left. Yeah. The same thing you guys have to do that. Do the correlation. Calculate the correlation for this one. For A and B, the correlation will be what will be the correlation for A and B. Very straightforward. It should be actually and go straight like this. Go to data file, data analysis, and so correlation. Okay. Let's do the anybody else's topic. Let's 75823. We do the correlation point in here. Okay. Then you do these things. Okay. Yes. But you don't need, you just need the standard deviation for the portfolio. That's all you need. Okay. Let's do the standard deviation for the portfolio. That would be nice. So let's do this. Two 2.68 and 2.6. That's okay. All right. So yeah, so that's how you calculate these things, but you can do it manually as well. I'll stop it in here. Okay. Let's do our attendance. Before I do the attendance, I need to start the recording in here.